Hey there, I'm Aaron Young. The US will probably avoid a recession, though inflation will remain sticky for the foreseeable future. The banking giants Goldman Sachs criticising proposals that would raise capital requirements for larger banks. For more, we're joined by Will Banks, the Executive Director of Shillings Capital, and Matt Grudenoff, Senior Economist at the Australia Institute. Gentlemen, great to see you. We'll start with you, Matt, if we can. What do you make of Solomon's comments, the CEO of Goldman Sachs?
Well, I think that bankers not wanting more regulation is nothing new. I agree that a recession in the US is now looking much less likely. But honestly, I think that the US do need more banking regulation. Just earlier this year, we saw a couple of banking collapses in the US. It seems weird that that they're already saying, well, no, we don't want more regulation. I think over the long term, not only would it help the US taxpayer who doesn't have to bail out as many banks, it will help the US consumers, both businesses and households, but it'll help banks as well. I think if banks look over the whole cycle, the good times and the bad times, more regulation actually protects them in bad times.
Yeah, it's a really interesting debate, Will, on this one, because post-GFC, under the Obama administration, we saw both an appetite and a desire, and then a whole bunch of new rules that came in. They were wound back by Donald Trump, which sent the stock market on fire. Obviously, we saw a lot of startups do really well, where banks were able to take more risks. One of them, though, of course, was Silicon Valley Bank, which, as Matt mentioned, collapsed because when you take big risks, sometimes it leads to big failure as well. How do we make sure through regulation that we don't ruin the appetite for risk?
It's a balancing act, but at the same time, these banks need to mitigate risk, not only risk within their own businesses, but also risk as well. I think that some people have got quite short memories when you look at what happened during the GFC. And as Matt said, we've already had some failures this year with regards to, First Republic, Silicon Valley Bank. I think part of this comes for two reasons. The first reason is increasing capital requirements means that these banks have got to potentially borrow more. With the increase in cost of capital, it's going to hit their bottom line, which is what they don't want to do. And the other reason is it's quite a good way, I think, to a certain extent, for also Goldman's to plug the fact that they're running with a lot of these IPOs, and to maybe even divert some of the attention that they got some massive write-downs of the commercial real estate portfolio, which are happening this year.
Matt, we talk about the GFC and there's a lot of different views on what caused the GFC. One is that it actually began during Bill Clinton's administration, where he decided to make it easier for a lot of people to be able to own their own homes, and therefore that led to the Bernie Mac and Freddie Macs of the world, who were able to offer these no-doc loans to people, and that was part of the regulation and the rules. Spin around 10 years after that came through, and obviously it led to the GFC and the unwinding of the housing market, which led to more regulation. So trying to get that balance right, as Will mentioned, of trying to make sure that people can afford and that banks can manage to lend to people who maybe don't have all the documents, but we want to be able to get people off being renters. How do we get that right?
Yeah, look, it's tricky. And I think that the fact that we had kind of all those no-doc loans and those loans to people who couldn't ultimately pay them back was part of the problem. But that in itself is a lack of regulation. If that had been better regulated, then we wouldn't have seen as many people with kind of loans that they had no hope of ever repaying, who they were only really hoping that the house price would go up, and so therefore they would sell soon after. They never intended to pay it all the way down. And that's essentially speculation. When you're just putting your money in thinking, well, it'll go up in value, not based on, well, I'm going to get a rental yield, then all you're doing is speculating. And we don't want to encourage speculation. We want to encourage investment, absolutely. And we want to encourage people to own their own homes, but we don't want to encourage speculation.
Yeah, all right. Now, China has begun lifting tariffs on key agricultural products, as well as sending the exports of its trading partners to record highs as the world's second largest economy begins to slump. What will happen to many of the world's economies that have grown alongside the behemoth? Will, your thoughts on this one, because obviously so many countries relying on China here. Talk to us about your thoughts.
Yeah, so I think it's interesting that the agriculture exports are kind of, I think they're hitting highs at the moment. If you look at the wheat, there's about 20% increase that have been exported to China, which is which is great news. It's overtaken Indonesia, and it's one of the biggest exports. So I think that's great news. The concern is how China can turn this on. They may be accepting certain exports, but there are other exports that they're not. So it's only recently that the trade of barley has been lifted, but there's still things where there are hefty tariffs on seafood products, for example. So they can pick and choose. We can't. Australia cannot, and globally, the countries can't get into a position of feeling comfortable that this is going to be a sustainable, reliable trading partner. Because, as I said, China can just turn this on and off, which can cause problems for those economies.
All right, we'll leave it there, gentlemen. Appreciate your time, as always. Matt Grudnoff and Will Banks there. Thank you. And that is a program for now. For more, you can head to tickernews.co. I'll see you soon.